Okay, let's take a look at the Chapter 3 Adjusting Journal Entries, and I'm going to start on page 137. All right, so let's take a look at adjustment number 1. It's an accrued revenue, okay, which means that we've earned the revenue, but we have not been paid for it yet. So look at the description here. It says Hi-Tech's accountant noted that Hi-Tech had performed $1,500 of advertising services to which it had not yet billed the customer. But remember, it doesn't matter when we bill the customer, it matters when we earn the revenues. So in this particular case, we do get to record the $1,500 worth of revenues. All right, so the debit goes to accounts receivable, okay, $1,500. So notice what happens here. We debit accounts receivable $1,500. Once we enter that, notice what happens to the current and total assets. They increase. Also, I've added a little something here to this worksheet that lets you know, try again, which means that the assets do not equal liabilities plus equity. So the other item that we need to do is we need to come over here to the revenue column, and we need to record an additional $1,500 in revenues. So notice what happens. The revenues will increase, net income will increase, retained earnings will increase, and the owner's equity in total will increase. And notice what happens. This cell right here comes back to equals to let you know that both sides of the entry were indeed made. All right. Now remember, when we're putting together financial statements, we're going to look at this in just a little bit. The equity statement is beginning retained earnings plus net income or minus net loss minus the dividends equals the ending retained earnings. So right now, notice what happens. The retained earnings balance that is listed right here is the ending retained earnings balance. But notice what happens here. Retained earnings in that specific account doesn't change because all the changes, revenues, expenses, and dividends, these three items right here that will ultimately affect ending retained earnings are still sitting out here in their individual accounts. We're going to look at this a little bit later in a little bit more detail. So let's take a look at adjustment number 2. All right, adjustment number 2 says the notes payable for $3,000 that Hi-Tech assigned on March 2nd required to pay interest at an annual rate of 8%. The formula for computing the interest is listed there. Okay, so the notes payable amount is listed there. You can see how the calculation goes. We've got 1 month's worth of interest expense that we have to calculate. So we start with the $3,000. We multiply that by the annual interest rate of 8%, and then we're only going to need 1 out of 12 months, okay? Because it's been 1 month since the note was outstanding. On March 31st was when that note was actually incurred, or the note was borrowed, and then we are now at March 31st. So let's take a look at the journal entry that we have here. So we record the interest expense. The expense is going up, so it's going to be a debit. The interest payable, or the liability for that interest, is also going up, so that's going to get a credit. So if we come over here to our interest expense, we're going to have to scroll down here and find our interest expense. Okay, we're going to debit our interest expense for $20. Now, also notice, only one side of that journal entry is posted at this point. It affected the retained earnings, it affected the equity, but again, we only have one side of the journal entry recorded, so now we've got to record the other side of that journal entry. So the other side of that journal entry is the credit to interest payable of another $20. So watch what happens here. The owner's equity went down, the interest payable is going to go up, which means liabilities are going to go up, so we now have a decrease in equity and an increase in liabilities. They offset each other, so essentially a zero impact on the right-hand side of the balance sheet equation, so we don't need any effect on an asset over here, okay, to balance the equation. All right, so let's look at adjustment number 3. We've got an accrual of salaries. So it pays its weekly salaries on March 26th and properly recorded an expense. Salaries are $360 each day and Hi-Tech will not pay salaries again until April 2nd. All right. So at that point, we've got 3 days. That's $360 per day times 3 days. So we've got $1,080 in interest expenses that have been incurred during March, but they won't be paid until April. Okay. So again, we've got to debit the salaries expense. Here we go, right here, of $1,080. So again, notice what happens. The expense goes up, the net income goes down, retained earnings goes down. All right. Then we've got the salaries payable. So now we've got to come over here and we've got to find salaries payable. It's going to get a credit of $1,080. So again, notice what happens. The current liabilities are going to go up, total liabilities are going to go up, and then our equation is going to come back into balance. Voila. Okay. Adjustment number 4. All right. Now we've got the unearned revenue. All right. So the customer, let's see, the trial balance shows that the customer paid $9,000 in advance for services to be performed at a later date. And then it goes on to say, based on Hi-Tech's analysis of work performed during March, it is determined that $3,300 of revenue has been earned. Okay, so here's you can see in the book, there's the journal entry. We would have to write that out in the general journal. Then we would need to post it into the general ledger. So when we post it into the general ledger, we come over here to revenues. Okay, there's $3,300 worth of increased revenue. So notice what happens. Revenues will go up, net income will go up, retained earnings will go up, and total equity will go up. Okay, but again, only one side of that entry is posted. So now we're out of balance. So then we've got to come over here to the unearned service revenue, right here. Okay, and we've got to debit that for $3,300. So again, the expense goes up, equity goes down, but now we're increasing the liabilities. So watch the current liabilities go up, total liabilities go up. Again, we come back into balance. So we decrease the equity, we increase the liability, so we essentially have a net zero balance or effect over here on the right-hand side of the balance sheet equation. So we are now back into balance, and we don't have to affect assets at all. Right? Adjustment number 5, we've got the prepaid expenses for supplies. So now we're over here under the $6,500 worth of supplies, and if you read through the description here, it says that they used $5,300, which were used. Now also notice what the description here is. They went in and they realized that there were $1,200 worth of supplies that were on hand. So again, we back into the usage. So the $6,500 that we put in there, we go into the supply closet. We now have $1,200 left. So the $6,500 minus the $1,200 gives us the $5,300 that's used. So we're going to reduce the supplies down to the $1,200 that are now actually in the closet. So when we reduce the supplies, notice what happens. Assets go down. Then we come over here to the supplies expense, which is down here, right here. Okay, and we have to increase the supplies expense by $5,300. All right, so watch what happens. Again, the supplies expense will go up, the retained earnings will go up, and, the expense will go up, the retained earnings will go down, and the equity will go down. Okay, so notice what happens. Now our balance sheet is back in balance again. All right. The next one that we've got to look at is insurance. Okay, so notice we had $1,200 worth of prepaid insurance. Remember, we have to pay that ahead of time. We use $200 a month. Okay, so under the prepaid insurance, notice the journal entry. Again, we have to write these out into the general journal, and then we post them into the general ledger. So notice what happens here. I'm going to post the prepaid insurance first, because look at what happened here. We started with $1,200. We used 1 month's worth. So watch what happens to the balance in prepaid insurance. It goes down to $1,000. Current assets go down by $200. Assets in total go down by $200. But now watch. This asset over here is now going to affect the insurance expense over here. So the insurance expense goes up on this side, Okay, so when insurance expense goes up, that means that net income goes down, retained earnings goes down, and equity goes down, all by $200. So now, in that particular case, we had a reduction in assets of $200, we had a reduction in equity of $200, so now our balance sheet account is back in balance. All right, then we've got adjustment number 7. Now we've got depreciation that we need to record. Now, in this particular case, we computed depreciation expense of $125. Now, understand that's associated with this property and equipment here for the $4,500. But understand what's happening here. Most people think of depreciation as the actual loss and market value of an asset. Now, in accounting, we do not use or define depreciation that way. Depreciation is essentially the allocation of the cost of an asset over a long period of time. Okay? So in this particular case, every month we're going to record $125 worth of depreciation. Okay? So when we record the depreciation expense, let's find depreciation expense, we need a debit there. So put in $125. Again, the expense goes up, net income goes down, retained earnings goes down, equity goes down. All right. So again, now we've got one side of the journal entry recorded. So notice it says try again. So we come over here to the accumulated depreciation account. All right. Now in this particular case, as we record depreciation, we record depreciation for each category of assets into a separate depreciation account. So if we particularly had maybe a building that we were depreciating, something like that, it would have its the building would have a separate accumulated depreciation account as well. All right. So now notice what's going to happen here. Accumulated depreciation is a contra account. So when we credit the accumulated depreciation account, the balance in that accumulated depreciation account is actually going to go up. But watch what happens to property and equipment. It's actually going to decrease. Okay? So you can see, contra account works contrary, opposite. So assets go up with debits. This is a contra account. It's going to go up with credits. And it's actually going to decrease the book value, or the net book value, of the property and equipment here. So notice what happens here is the assets, total assets, also decrease. So when we recorded the expense went up, the net income went down, retained earnings went down, equity went down. So now we record this contra account over here, which then decreases the asset side. Okay? So now our assets equal liabilities plus equity is now in balance. Okay? Okay, so you can see when we compare our balance sheet that we have here in Excel to the list of general ledger accounts on page 139, you can see that they do indeed balance. Okay, so the next thing that you're going to do is, once you've posted all of your journal entries, the next thing that we have to do is we have to test to make sure that all of the debits got posted as debits and all the credits got posted as credits. So if you'll click on this next tab here that says Adjusted Trial Balance, if you click here, you can now see what the new balances are in the account. So notice what happened. After the daily journal entries were posted here, these were the balances right here. After we posted the adjusting entries at the end of the month, here are our new balances here. So again, you can see this same trial balance on page 141. And once we have this trial balance put together, now we are ready for financial statements. Okay? Now, let's go back to this layout right here. So I want to really point out to you what's happening here. All right? So, one, remember, ultimately the retained earnings will change, but only after closing entries. So all of the revenues, expenses, and dividends are recorded in their own separate accounts, and we don't have any direct effect on retained earnings during the month. We only have an effect on retained earnings at the end of the month once we close revenues, expenses, and dividends. So if you look at page 142, you'll see the layout of the financial statements, and we start with the income statements. So we're going to start with revenues minus expenses, and you can see each one of those listed there. Then the net income or loss, in this particular case it happens to be net income of $31.75, and then we move that net income down to the retained earnings statement. So understand these first two statements are really like a reconciliation of what this retained earnings balance is supposed to be. So we calculate net income on the income statement, then we include dividends in the retained earnings statement, and we get an ending retained earnings balance of $26.75. Okay, so the $26.75 is then going to be pulled down to the balance sheet. So again, look what happens. We've got assets of $24,975. You can see that right here on this spreadsheet as well. You can see liabilities of $10,300, and then you can see owner's equity of $14,675. So you can see how the general ledger flows into the actual financial statement. So again, let's click on the trial balance. So we'll pick up again here, this group right here, revenues minus expenses will be picked up first. Okay, then we will include the dividends picked up there. Okay, we'll calculate an ending retained earnings balance. Then we'll move into the balance sheet and we'll pick up all these accounts up here, and then we will include the retained earnings balance that we calculated from the revenues, expenses, and dividend accounts down here. Okay? All right, so that is adjusting journal entries. The next recording will be about closing entries.